Hello, everyone. Welcome to Horizon Dubai. Salam alaikum. My name is Adrian Coxon, and I'm the Chief Marketing Officer at EXANTE, and I'd like to formally welcome you to this event. We created the Horizon series as a place where we could bring together international economists with investors to discuss the markets, what's going on in the markets, have debate, try and find opportunity. This is our fourth event. We did our inaugural event was in London. We did an event last month in Poland that you might have seen online. So I'm really excited today. Trumponomics 2.0 is the theme. And I don't think we could have picked a better week to be having this kind of debate with what's been going on last week in the markets. I'd like to say three things quickly. First, we are doing Chatham House rules. So any journalists in the room, you're free to use the information that you hear here. But if you want a direct quote from any of our panelists, please come and talk to us later and we can give you a direct quote. Second, we're going to be doing a few polls during the event. So I'd like you to put your phones on silent so you don't disturb the panelists, but we're going to be using a QR code and you're going to get to vote on a few things as we go along. And then third, I would like to welcome to the stage one of our co-founders of the company, EXANTE. It's Gatis Iglitis, and he'd just like to say a couple of words.
Ladies and gentlemen, thank you for joining us today at EXANTE Horizon event in Dubai. First of all, I would like to thank our marketing team and particularly Adrian Coxon for pulling this event together. And as Adrian already mentioned, EXANTE Horizon was made as an international forum where investors can meet with market experts, sit down, discuss what's shaking the markets. And I'm particularly glad that this event is taking place in Dubai because we share in EXANTE the same value set as the UAE. We embrace technology, innovation, and meritocracy. And having said these words, I would like to invite our head of Middle East, Mr. Ashraf Beshser, and he will tell us a little bit more what EXANTE is doing in Dubai. Thank you.
Thank you very much, Gatis, and welcome everyone. I'm so pleased to be here at the Dubai Palace with this amazing group of industry leaders, financial experts, and investors. I'm also proud that our Dubai office, located in Dubai International Financial Center, the IFC, opened in January 2025 with our team of experienced financial market analysts and experienced team professionals. At EXANTE local office, we actually can help you and investors to have access to more than 50 global markets internationally and more than 2 million financial instruments on our platform. Our platform is a fully customizable, award-winning platform. So we are actually here within the event. We're going to be here with you. We look forward to meeting with you, answering your questions if you have any. And without further ado, I would like to progress to the main event with our panelists and the panel moderator, our Global Head of Research, Dr. Renee. Over to you, Dr. Renee, and enjoy the event. Thank you very much.
And welcome to our Dubai Horizon event. As mentioned, I'm Dr. Renee Friedman. I'm Global Head of Research here at EXANTE. And today we are very lucky to be joined by a panel of some very distinguished experts in their areas. We have at the far end, actually I'll work my way down a little bit, right next to me, sorry. We have Deepak Mehra, who is the Chief Economist at the Commercial Bank of Dubai. Seated next to him, we have Zeina Rizk, CFA, who's partner and co-head of fixed income at Amwal Capital Partners. Next to her is Serena Sebastiani, who is Director of Financial Services Consulting and Virtual Asset Lead at PwC Middle East. And at the far end, we have Dr. Sree Kochugovindan, who is Senior Economist at the Aberdeen Research Institute. And some of you actually, if you're watching Bloomberg this morning, would have seen her on Bloomberg at 8 a.m., I think it was. Okay, so fabulous panel lined up for you, lots and lots of information. But before we get into this, we'd like to, as mentioned by Adrian, have a poll question for you. So what I would like to ask you to do is, if I can just advance this, please use your phones and get that QR code. All right, again, slide, I'll give you a moment for that. And just answer the following questions. I'll give you a minute to log into that. Is everyone in now? Give them a minute. See if still a few people putting their phones up trying to get the QR code.
Let's see if it works from here.
It's there. Yeah.
No active polls, I see.
Oh dear, what's going on?
Yeah.
Will we have it in a moment? Polls active? Sorry. Again, technical issues, yes. No, but those whose people were. Okay, right. My apologies. Apparently, Slido will not become active until after we finish. But it's actually okay because the questions that we have on there are really about what your thoughts are for the UAE and the wider region in 2025, as well as which sectors globally by asset class you think will outperform in 2025. So we'll go through those. Oops. And then we also, my apologies, I'll go back to this. We also will be asking you at the end to go back to this, and so we know how you feel about the event overall at the end. But it's very important in terms of the overall view, which might change, of course, from today's panel. So before we delve in, let me set the scene thus far a little bit. Right, it's been a wild time for markets, as Adrian mentioned. The S&P, as of yesterday, things are shifting around a little bit today. It's shifting on a minute-by-minute basis. The S&P 500 was in bear market territory. The VIX was at its highest levels since COVID. We have had over 9 trillion go out of equity markets in the past 3 days. And of course, all this is due to Trump's tariffs. So we're going to get very much into that in a moment. And the reciprocal threats that we see coming through. And all during this, the Fed has been saying, of course, that they're not going to be rushing in. But we're going to debate a bit today about what they may be doing next and what the impact, of course, that will have on the wider market. We'll also be looking at the point of dollar weakness. It's been up, it's been down, it's been a bit all over the place. And of course, we've had that move into gold, with gold reaching new highs last Thursday before it's coming down a little bit. It was up to, I think it was $3,187 a troy ounce, around there. It's back down to a little under 3,000. We'll be discussing a bit as well what will be happening with gold moving forward. And of course, crypto. We know we have a lot of crypto fans here, but there's a lot changing in the crypto universe in terms of regulations and products themselves that are changing. And of course, crypto being part of the wider market of assets that people can invest in, we have seen that massive drop in crypto market capitalization by 30% from 3.9 trillion to 2.7 trillion by April this year. So December, 3.9, step right, quite a bit down. And of course, in amongst all of this, we have geopolitical risks to consider. The changing dynamics between OPEC member states and the US, given the new US policies regarding energy production. We have NATO tensions, not just between the US and Europe, but also between the US and Turkey, and potentially the wider Middle East region. We have Turkey's role changing very much within the Middle East in the post-Assad world. That's kind of gone a little bit on the back burner to some people, but it's still a very important issue when we look across the wider Middle East, the implications across the wider MENA region. And of course, we have the situation vis-a-vis China, difficulty still between the US, China, and Taiwan, and what's happening in terms of, particularly within the GCC, the UAE, making major push to deepen ties with China. So before we get into some of the nitty-gritties of the questions, I'd like to ask the panel to start today's discussion with their views of the world today. It'll take about 5 minutes each. So to begin with, I'm going to turn to Deepak. You have decades of experience in this region, globally, of course, as well. So if you give us a bit of an overview of what is happening, what you think is happening, and why.
Okay. Thank you. So there's never a dearth of crisis and the reasons for crisis. So if you look at the last 25 years, we had a stock market crisis, then we had a housing crisis. After the housing crisis, everyone fixed the housing market. And then we had a health crisis, which was not expected at all. And then we are now trying to fix that. And out of the blue comes a geopolitical policy crisis, completely outside the realm of possibilities that people would have thought 12 months ago, where regulators and risk managers are trying to fix all sorts of crises. You have a regulatory self-imposed policy crisis. So that is the wider picture as I see it, which we are facing right now. But luckily, this crisis has come at a time when the world is much better prepared and is in a much better position to handle this crisis. But we will discuss that between all of us. But very broadly speaking, if you look at the US, it couldn't have been at a better time when the economy is doing extremely well. The corporates, consumers, their balance sheets are extremely strong. And finally, the Fed has, not only Fed, other central banks, major central banks, have a lot of room to cut rates. So this crisis has come at a time when the world is very well prepared for it. Would this crisis now linger on and get into a full-blown crisis where we could have recession not just in the US but across the world because of these tariffs? It's anyone's guess. I wouldn't like to give my views today because anything that I say now could be outdated in 2 hours when Trump wakes up and gives some other statement. But there is a clear risk that yes, this could get worse. My base case is that we are not heading towards recession, neither in the US nor anywhere else in the world. And that is my base case and starting point, Rini. So this is where we are.
That's okay. Let's see. We're gonna have some differing opinions, which are great. So Zeina, I'd like to turn to you as someone who spends her time focusing on the wider MENA region, the developments within that, as well as, of course, looking at global markets. What is your view of what's happening within the MENA region today, the direction that you see it moving, and do you see any particular trends are emerging, or is it just too difficult to actually talk about trends given the pace?
Absolutely. So first, let me start by touching on the US market and what's happening. I agree on the base case, but I'm a bit more optimistic than Deepak from a perspective of, yes, balance sheets are very strong, leverage is low, corporate leverage is low, unemployment is still strong, NFP was very strong. The economy is strong in general. Looking at the Fed balance sheet to GDP, liquidity is still ample in the market. And any index of liquidity we look at, liquidity is still there. So I don't think there's an imminent recession, but what I think is that it can change very fast. For me, it's too early to know what's happening with tariff, the impact of tariff, the extent of tariffs, what part of tariffs are there for leverage, what part is there to stay. And by the time we finish to analyze what is there, it changes. So the way we look at it is positioning, trying to be on the defensive side, because your upside downside when it comes to fixed income market does not compensate for the uncertainty, and the risk is there. So your upside is a couple of points from here, your downside, if we actually go into a recession, is wide. Looking into the GCC and into the MENA region, fundamentals are very, very strong in the region. It depends on all the GCC countries except for Saudi have twin surplus, assuming oil doesn't drop massively. And the main risk for our region obviously is oil. Funding need is massive. We'll touch on that, I guess, later. And MENA is divided, if you add to that, Egypt is a completely different spectrum. So from a fundamental perspective, we've seen a massive change in terms of doing the right things, the right steps for the IMF to be supportive. And we've seen some sort of, which was the main thing, which is the letting go of the currency somehow. The other aspect, which is transitory, like in the sense that all the MENA guys also look at Turkey, we can touch on that also and see that we have seen significant changes that were put on hold recently by the political aspect that happened, which spooked the market and had the central bank intervene in the currency. So all in all, we do have different aspects depending on where you look, but the major risk that lingers on all of those is geopolitics from one hand and the tariffs and their impact on another hand.
Great. And we'll obviously be getting much more into that in terms of the future of the global economy. But one of the things, of course, is the different sectors within that economy. And Serena, I want to get into this with you. You're based in Dubai with your focus on cryptocurrencies and digital assets, but your advisory work and analysis considers the changing situation, not just in the region, but obviously globally. How are you feeling about what is happening in terms of growth in the cryptocurrency markets? What are your quick thoughts, given everything else that's going on that's pushing or hindering the Middle East and even global markets when it comes to the cryptocurrency world? What are your thoughts at the moment?
Well, I could say something, I could repeat something that Deepak has said already. So anything that I say now might change in 10 days, a week or 10 days, right? Especially in the digital asset world where a cycle is actually 12 days long. So I'd like to ask actually the audience just to understand what the level of understanding is here. How many of you, raise your hand, or operates in the digital asset space professionally or personally? All right. Well, I expected more, actually.
50% probably.
I expected more being in Dubai, so being the event in Dubai. So look, to your question, so for me, this is like the fifth cycle that I live, right? So everybody's scared about being in a bear market. I've seen this up and down since the big bull market in 2017. So it's definitely not the first time. And markets are emotional in the short term, as you know, in any other asset class. They're more rational in the long term, inshallah. I feel energized anyways. If you ask me how I feel about what we are living now, very energized by momentum. So we are living in a world where, and in a phase, in this region specifically, where digital asset in general, not only crypto, but digital assets, stable coins, CBDC, tokenizations, are really not an hype anymore, but they are really going to merge with the traditional financial system that we are used to. We are definitely entering a very complex and nuanced environment, and this is why we see the roller coaster. From January, we were at all-time high, 110 $1,000 on Bitcoin, and I mean we are now 85 more or less this morning, $1,000. So, but again, we're living the roller coaster, so very complex environment. But a few things that are happening that are very interesting, for which I keep my very positive outlook for the future. We are witnessing a moment of unprecedented global interest and regulatory attention, right, to digital asset. And the more the regulators are into this game, and sovereigns and institutional, the more obviously digital asset will be adopted globally. So it's international validation. Bitcoin ETF, not only Bitcoin and Ethereum ETF that have been approved by SEC, and even before Trump actually stepped in as a crypto pro president, right? And even before the crypto task force that has been set up in the US. So we have a sovereign interest, not only from El Salvador and Bhutan, but now also from the US and from our neighborhood in Abu Dhabi. So last month, Mubadala actually has invested an interesting stake into Bitcoin. And major banks, JP Morgan has been in the game for a very long time now, since 2018. Goldman Sachs, BNY Mellon is developing a full tech stack for tokenization and custody. So the time that the big banks are in, then obviously the others will follow. Regionally, highest skin in the game by regulators. It is, I think, one of the most comprehensive regulatory framework that we see globally is here in Dubai with VARA. ADGM, very, very advanced as well, and Bahrain, that is usually in the region, has had the scene for fintech and innovation. But also banks traditional banks are slowly approaching crypto space and offering these solutions to their investors as well, as you know, mostly bundled into wealth management type of solution, but offering to the retail market, which is very interesting. Still conscious about you know, the risk compared to big international banks, but we see them in the game. And then we have the largest global players establishing in the region. I mean, we see Binance, OKX, Crypto.com, they're all here establishing their quarters here. So very, very bold about this place to become actually an epicenter for emerging markets.
Okay, so moving on from emerging markets, and we're going to go a bit more global as well. Sree, your remit is generally, I said, much more global, coming in from the UK. What do you see, what is happening, you know, broadly in the US, how it's affecting Europe, as well as, of course, this region a bit, affecting Europe, the UK, and the wider world? Essentially, what are the top couple of things that you're really focused on from that wider view?
Yeah, I think obviously it's a very interesting time at the moment with, as we've mentioned before, a very wide range of possibilities, possible outcomes. And I think in the near term, to determine those outcomes, to get there, really, from a global perspective, it's a case of, you know, US exceptionalism now seems to be behind us. That was very much the narrative just at the beginning of the year. Mag 7 was still very popular, you know, just around the end of last year. So we've really moved on from there, and the question mark from here really is about the tariffs policy, and what is the end game here? What is the potential off-ramp from where we are at the moment? Is this a revenue-generating policy? Is this about negotiations? Is it a combination of the both? Because it's very confusing. We flip between the two. Next line, are these policy is going to stick? Do we stay at these tariff levels, or is this a cap where we negotiate lower? What is the scenario there? How long does it take to negotiate these trade deals or compromises? Because if this rambles on for weeks on end, the impact on uncertainty, not just in the US, but globally, is going to be quite meaningful for the markets, obviously, but also for consumers, for businesses. How do you make investments? How do you decide on shipments in this environment? So the longer this is drawn out, it sort of narrows out some of the good outcomes potentially, and you could end up with, some great other tail risks materializing. Also, in this new tariff world, what are the spillovers from here? Do we start to see, negotiations, lower tariffs here and there? Are we then forced into a situation of anti-dumping sort of policies as well? Does it escalate further? There are many iterations of this that we need to start thinking about, unfortunately. But I think overall, if we try and take a step back, the next few weeks, the rest of this quarter is likely to be quite volatile in markets, lots of questions, more questions than answers. But if we try and look beyond that, then we'll start to possibly get some certainty into the second half of the year. So the next set of questions, what is the economic spillovers? We've talked about recession risks rising in this scenario. So tariffs are a tax on consumers. There's a price level hit as well, so the price level will increase. But are there indirect impacts as well, which then lead us to a recession, or something that's more akin to stagflation? After all this campaigning against inflation and bringing inflation lower, do we then have a very challenging set of a challenging environment for central banks? And so if we then start to look at the Fed versus the ECB versus BOJ and then PBOC, I mean, all of them have a very different dynamic here. So we went through a phase during the pandemic, during the war, where policy was pretty much synchronized in terms of monetary fiscal easing, monetary and fiscal tightening. But now we have a Fed that's probably a little bit stuck in terms of, well, we can't tackle growth yet. We need to see the hard data really deteriorating. And then the ECB, what happens in Europe? Yes, there's a growth hit, but potentially it could be more disinflationary than a stagflation outcome that you see in the US. So you get some very divergent outcomes from the economy, and also divergent investment opportunities. So right now, you'll see a lot of volatility, but I think as we get into the second half of the year, we'll start to get a bit more clarity in terms of what the central banks are thinking, what are the offsets, the sort of support mechanism that you get from the Chinese government, from the Japanese government, are there subsidies? There are all these different outcomes that we need to start to materialize before we can then start cherry picking, I think, different opportunities across assets.
Excellent. Please, Deepak, let's go right in.
Just adding to that, I'm again trying to bring more from an optimist's point of view, that there are possibilities that this doesn't drag on, which is the biggest worry right now, because this drags on, has many other fallouts. But before that, it is important to note, why is Trump doing what he's doing? So Trump sees that manufacturing has moved out of the US. But manufacturing moved out of the US because US went into value-added services sector and didn't want to do the low value-add manufacturing work, which went out. So that's how the US became more prosperous, and the consumers benefited because things became cheaper for them. In 2000, before China joined WTO, 25% of global manufacturing base or capacity was in the US. And China only had 6% of the global manufacturing capacity. That was just 25 years ago. In 25 years, the US manufacturing capacity, which was 25% of the world, has dropped down to 11, and Chinese, which were at 6% of the global capacity, have risen to 40 to 45%. So that has happened because it has benefited the US, it has benefited China, it has benefited all of emerging markets, all the prosperity that we see around the world and all the people who have come out of poverty in the emerging markets are thanks to this dynamic. Now, this can't be reversed by imposing tariffs.
Exactly.
So that was a point I was trying to make. Now, this reversal would mean that textiles and shoes being manufactured in the US, imagine the cost of labor and the cost of manufacturing it. It doesn't work out. Now, why does Trump need tariffs? Because he needs tariffs because he needs to show revenue gains, which then he can pass back as tax cuts later in the year. Because in his agenda, there is tax cuts as well. Now, he cannot announce tax cuts, especially corporate tax cuts from 21 to 15%, on an unfunded basis. That would be fiscally unviable. So he needs these tariffs. And therefore, he's kept this two-tier, 10% baseline and much higher levels for negotiation. My personal belief is that the 10% baseline is not going anywhere, that he will have to carry, and that gives him about $400-500 billion, which he can then declare as additional income, which would justify the tax cuts.
But that can cause a very big risk if it goes out of hand, right? I mean, theoretically, that's what he said, increase tariffs, cut taxes to zero. Economically, it doesn't work. Economically, the math wouldn't add up, right? And from the other perspective is the array of outcomes. I mean, we've heard different outcomes. We don't know if we're going into a recession or not. We don't know if inflation is transitory. Funny to use that word, but the Fed used it again. And okay, fine, the first time that the tariffs were there, the first term, substitution was easy. We had a blip. Yeah. This time, we don't know, and we're not sure. If it goes out of hand between those, that is, you can argue that in the long term, shifting away, decentralizing and deregulating into the private sector, so moving away and the firing into that Doge is doing, but the speed at which it's being done is destabilizing the market and is freaking out the market. And a lot of people that were fired are brought back because of one reason or the other. So if it goes out of hand and you go into a recession, that $2 trillion deficit needed to be funded is going to become way bigger because your tax revenues and tariff revenues are going to be lower. So it is a pretty risky way of dealing with the current situation.
But yet, I think he knows that, because if the economy slips into recession, the population in the US will not forgive him. He has a midterm elections coming next year in 2026. And if he loses his majority is a thin majority in both the houses. So he doesn't have an absolute majority. Absolutely. And it's very easy for that thin majority to slip out of his hands. And he will then become a lame duck president. So I'm sure politically he is astute enough to understand that whatever game he's playing cannot be dragged on for too long. Absolutely. And that is the positive side, and that's the optimistic side of me, which looks at the political fallout.
Okay, bearing that in mind, whether or not we're looking at recession, how long these tariffs will take effect, it's obviously having an impact on the dollar. Okay, so let's talk a little bit, if we can, about that point of this impact on the dollar, potential de-dollarization happening. As a result, de-dollarization has already been happening through central bank purchases, the balancing of the portfolios, for quite a few years now. Anyway, are we seeing more of a movement potentially further out of the dollar? What are the implications in terms of treasuries, as well as I'd also like to get into, so we'll start off with that, if we could, in the implications of how this is hitting bond markets, because we've seen yield curve steepening, then it was dropping US treasuries, and now it's back up. It's kind of all over the place. Markets don't know what to make of what's happening very easily. The dollar is still down, I believe, this year overall. What does that mean, particularly in this region, which is very dollar dependent? And then we can get into, I'd like to get into a question on that and how that relates to the price of cryptocurrencies as well, and stable coins and CBDCs on that following through. So if we can start off with fixed income, what are your views on that coming through? Somebody would like to, get a little, their views on what's happening at the moment and where to be in terms of positioning.
Absolutely. So that would be divided into local currency and pegged currencies. It's not all bad news for emerging markets because dollar weakness is in general good. But what's bad would be, why is the weaker dollar? So if it's a weaker dollar on the back of a recession and the risk-off mode, then you have a way completely different impact than if it's just on substitution. So how far the substitution is going and how far the substitution is going to be imposed is going to be dependent on what's the outcome. So for our part of the world, from the beginning of the year until now, we were very tight. Spreads were extremely tight, and treasuries were range-bound, and you've had some sort of nervousness in the market as to nothing has value, yet everything is moving sideways, and you don't want to delever, or you don't want to step out very quickly. You would underperform. This move, funnily enough, got us moving higher on high yield, but we got back a lot of this move in this part of the world. So, and then if you look at Egypt and Turkey, these two benefit from lower dollar, obviously, and they also benefit from the effect, especially for Turkey, the effect of substitution. So if you're substituting away from dollars and away from dollar goods because of tariffs, Turkey is a very good, I mean, to be in. And for the pegged currencies, obviously a weaker dollar is always a better good news than having a stronger dollar. So all in all, it's not bad news unless you're in a recession. So if the weaker dollar is driven by a recession, then you're going to have a risk-off mode, then you're going to have spreads widening and risk asset repricing higher.
Sree, you look like you wanted to comment on that.
Yeah, I think the outlook for the rest of this year doesn't, in my view, look so promising for the dollar. There are sort of different challenges there. I think part of the challenge, unfortunately, is that because of all of this uncertainty, it has led to a little bit of a credibility issue as well, which is going to impact the US dollar via sort of a shift away from US assets potentially. So at the moment, what we're seeing is like a generalized risk off across all the markets globally. But I wonder if going forward, it becomes a little bit more, as I said, this quite disparate and divergent. And we could start to see, if you think about the fundamentals in Europe, for example, there are, at the moment, obviously, uncertainties, but we have a different set of policies there. Germany has just removed the debt brake. That fiscal easing across Germany and Europe there is quite a structural long-term boost and a shift away. Again, it's an independence away from US in terms of defense as well. So these longer-term drivers could be quite sort of a rebalancing there from dollar towards euro, longer term. I think sometimes if you look at other markets, say yuan, can that be a contender? I wonder if, the depth of the market, liquidity, et cetera, there might be some capital constraints there. But yes, I wouldn't be surprised to see over the course of this year this kind of rebalancing that might be favoring Europe and might be interesting to look at.
I'm going to throw this out there. What about in terms of the BRICS countries? We've had a bit of a discussion, they've had, I should say, amongst themselves, that pushing the de-dollarization. Do you think that this will help their argument?
My only point about the BRICS coming together to form a currency, for me, it's a joke more than a financially viable possibility, for a very simple reason that when you had 19, 20 countries in Europe coming together, which were all AA and AAA rated, and they came and formed a currency called the euro, which was supposed to replace the dollar, and they couldn't achieve it. Then these BRICS countries, which half of them are junk rated, the other half can't sit on the same table with each other, and some of them are under sanctions. It'll be the biggest joke of the century if they come together and form a currency. So no way, that doesn't even
it's a bit of
come
the blind
into the
leading the
consideration.
blind, right? Yeah. It's a bit the blind leading the blind.
Yeah, the drunk trying to get support from the other drunk. Yeah.
So that leads us, Serena, to cryptocurrencies. Will crypto come in as, it's been referred to as digital gold? Will it be a replacement through the use of CBDCs? But those are still linked to the dollar. So what do you see happening?
Well, some of the BRICS are contributing to bridge the CBDC that the UAE participates to, right? So that's, let's not call it a currency for BRICS, but as anyways a way of trade between these countries. And China is the main contributors there. And BIS has a large setup in Hong Kong as well. So That's something we have to keep in mind. Like when people and when we speak about, okay, can crypto replace dollar or de-dollarization through crypto? Now, obviously I work in this space and I'm really passionate about digital asset in general. I don't see crypto as a replacement for the dollar though. First of all, we have limited supply, exactly as as gold, or so that's by definition. You can't print forever, and if we go to the dollar and we go back to tariff and depending on the outlook we all have, my personal outlook is actually positive, right? I mean, we are going in a maneuvered somehow recession to allow the US to repay $9 trillion worth of debt and possibly this year. Then tariff can be lifted, we'll be left with low rates and potentially print more money. And that's, I mean, I'm hopeful at least that that's the game that is playing, and so this is a demonstration of what you cannot do with crypto, although programmable. So replacement, if we want to call it this way, is potentially the stable coin. Mm-hmm. So stable coins that are currency backed. Although still the two main stable coins in circulation, USDT and USDC, mm-hmm. are USD backed stable tokens. So actually on these stable coins are the go-to asset for countries with high inflation rates, and with very high rate of currency fluctuations. So Turkey, for example, Turkey is a textbook for us in crypto. Preserving value in Turkey is crypto, highest crypto adoption in MENA. So, I mean, not a replacement. There are definitely ways to use crypto to preserve value, and especially in emerging markets. If we look at MENA, then most of the countries in MENA are actually dependent to the dollar. So speaking of de-dollarization here becomes really a geopolitical discussion.
Okay, that becomes quite scary. Now, if we're not looking at recession, but we are looking at potentially, because the tariffs going back and forth, the market volatility that this is creating, it makes for a very uncomfortable investment environment, as we've discussed, both within the US and globally. People are very uncertain what to do. So when we look at equity markets, which have been down last quarter, particularly US equity markets, even globally a bit down, although recovering in Asia, where do we see this hitting equity markets potentially if we are not looking at recession, but we're looking at this increasing volatility and the risk of stagflation coming through? So if we don't have recession, we still might have end up in a stagflationary situation.
Yeah, so in terms of, you don't necessarily need the recession. It's the fear of the recession that's really driving the pricing now. And also the fact that inflation expectations are picking up. That's all part of this sort of very heady mix within the market pricing. I think what's quite interesting is in terms of, potentially looking at sectors and trying to pick out those sectors that are less vulnerable to tariffs. So steering, underweights in autos, chemicals, potentially, that could be a sector that's affected. And then steering towards healthcare, utilities, but maybe also looking at...
The defensive stocks.
Defensive stocks, but maybe also looking at smaller caps, which are less exposed to tariffs. They're much more domestically focused. So again, there you have your regional allocation within those smaller cap sectors as well. So I think that's the kind of positioning to be thinking about. But until we get some sort of resolution, I think the fear and the market pricing is steering towards that potentially a stagflationary situation. But also within fixed income, we were talking earlier that you're seeing this divergence in terms of OAT to Bund spreads starting to pick up, or BTPs, and just looking at maybe a fiscal concern as well building. Hopefully that is dealt with, and the fact that Treasury yields have been so volatile. But we have been talking about this potential extra premium in Treasuries as we go into this year and next, and it just seems that the current tariff policy has kind of really pushed a button there within markets. So I think there are a number of different hints within the market pricing there and concerns that hopefully can be eased over time if we get some policy clarity.
Yeah, markets are very much in an uncharted territory. So if we've seen the move yesterday on treasuries, and markets started discounting 6 cuts, that's a massive recession. If you're in a massive recession, you can't expect to not have a fiscal deficit that is massively bigger. So you feel people are lost, people are still not knowing how to position. And as we were saying, if this lasts for a long time, markets don't like this uncertainty. So you will have people shifting into a wait and see mode, maximize cash, sit on a very defensive stand, and wait for things to unfold. Because given how uncharted it is, you really don't want to be a hero and be wrong.
So,
on equities, a few things to look at is when WIX, the fear gauge, goes to levels like 60, which it touched yesterday, equity markets tend to bottom at that level. So one theory is that the markets could have bottomed when WIX hit 60. Now, obviously, this is subject to the known conditions. If the known conditions change, WIX could once again spike to 60 and the markets could fall another 6 to 10% from here. But when you're buying, and I'm talking more about the US markets, when you're buying when S&P 500 index is down 20% and the WIX has hit 60, it has never happened in the history that you don't make money 6 months, 12 months, 18 months down the road. So the moment you have a time horizon clear in your mind, I think the money-making opportunities are around us. Now, that is point number one. Point number two, I still believe that US exceptionalism is unchallenged. It may have taken a back seat, but it's not out. For a very simple reason, that show me the innovative companies that we have in the US anywhere else in the world. Show me
China.
Yeah, but then,
exactly.
But then is the world adopting Chinese technology or the US technology? So let's look at Europe. What options does Europe have? Now, every company in Europe that needs cloud services will either have to go to Microsoft or will have to go to Amazon. It's not going to Alibaba. Anyone who wants chips in Europe or Asia is buying it from NVIDIA. They're not buying it from anyone else. Give me a parallel of Google anywhere in the world. How soon can you switch out of Google just in case you don't like American companies? So they are so heavily embedded that it will not take years, it will take decades to get out of.
But that's starting already.
Where?
You're starting to see BYD challenging Tesla on so many levels. You're starting to see DeepSeek challenging ChatGPT. You're starting to see a lot of technology starting. Are we shifting away from the US and de-dollarizing and finding? No, obviously not. One, because we don't have an alternative yet. But there are alternatives are starting to show up. You want to argue, are they as good or not? Debatable depending on what you're looking at.
It'll take a while. I don't think we have an alternative for the cloud technology that Microsoft and Amazon
because you have
provides.
A governance issue there.
Yes, exactly. So how soon can this shift over? So that's point number one. Number two, yes, China does pose competition.
And we look at users as well, right? Adoption, number of users. I mean, if we look at Alibaba, you mentioned Alibaba, DeepSeek, and I mean, in terms of users, Alibaba is higher than Amazon.
Yeah,
so
that's true.
I mean,
Also, it's a case of maybe Europe some developed markets are very much tied to Microsoft, as you say, it's regulation and whatever. But what about, China's trying to push towards this sort of leadership in the global south, and really trying to engage with Asian partners and collaboration. It's not easy. Obviously, there are local tensions there, but it's possible that these other alternatives may be adopted across the region. So, I don't think we can fully discount how these trends can develop over time. And I think, it was a wake-up call, actually, I think earlier on this year when we saw that DeepSeek and the fact that, and the impact on data centers, how power hungry are these different apps. And I think it does raise a lot of questions. It's true, it takes a long time, but I think we've just had a warning sign there that we need to keep an eye on.
Agreed.
Yeah. And particularly in countries in emerging markets where the technological leap happens very, very quickly.
Very fast, yeah.
As opposed to the older, more traditional markets where they have to get around a lot of the regulation that exists, and that takes time. Okay, given what we've seen in terms of whether or not going to be recession or stagflation, bond markets are a bit all over the place. We're not quite certain where we want to be necessarily, unless somebody wants to say where they think they ought to be in terms of duration on this, or do you want to hold back on that? The big thing that we see coming through, of course, and very relevant for this region is commodities. Okay, obviously oil. And oil's been down so far this year, despite we have negotiations, presumably, between the US and Iran this coming weekend. See what happens there. We've had the US, its statement, the executive order that Trump signed in January in terms of expanding US production. We have OPEC at the same time now agreeing to expand production despite the fact that prices are dropping. So what are the implications in particular for this region to be able to, because it's also, we've seen debt issuance increase across this region. So what are the implications for this region in terms of its growth and as well in terms of global growth when we think about this, when it comes to oil, LNG, et cetera? Because we have seen them move away from many of the purchasing countries from their green energy agendas. So they're back onto oil in many ways. Any thoughts on that?
The OPEC Plus, we've had a double whammy on that day, the OPEC Plus. But the arguably is that Saudi was saying that they're losing market share because a lot of people are not abiding by. And arguably the other factor is the drill, baby drill that came out that pressured them to also do that. Yes, we have seen diversification away from oil in most of the GCC economies, but let's face it, oil is still the main driver of the GCC economics, be it economies and be it spreads. All of the GCC economies last year have had a twin deficit, as I said, except for Saudi, and Saudi was expected not to have it last year and not to have it this year, but if oil goes to 50, I think we're going to have a massive need for all the GCC economies to tap the market more. And I think we are going to have a widening of spreads across all the economies in the GCC. How much depends on, as I said, if we have a massive drop to 30 that happens overnight, that's going to cause a panic, yes. But if oil slowly drags to 50, we're going to see supply coming up, which is going to cause additional upward pressure on spreads. The other aspect is if it increases because of geopolitics. So Saturday we have a very important meeting on geopolitics, which I think can give us an indication as to the tone that we expect to see in our region. But yeah, oil is still obviously the main driver despite diversification.
You mentioned the twin deficits, but the US also has twin deficits.
But you guys can print as much money as it wants.
Exactly. So if we think beyond oil and we think about the other big commodity, of course, is gold. I mentioned this slightly earlier. Gold has been rising almost non-stop since 2022. It was up about 135% in 2023, over 27% in 2024, and about 19% in Q1. How are you feeling about gold? People, again, I'm going to bring this back to crypto as well, because crypto, people were saying, the new digital gold, it was performing better.
Gold.
Mm-hmm.
We tokenize gold.
How do we feel about, so people, if we're very uncertain about what's going on in bonds, we're uncertain about everyone should be just into cash, should they be in gold? Is that still the safest thing for them to be in? or should they be looking elsewhere?
I think what we've seen in the last few days, actually, we've almost had a very vertical increase in the price of gold as a result of geopolitical risks. So it's been a real. So gold, the drivers of gold change over time. It's an inflation hedge. It's geopolitical risks, safe haven. I think what we've seen in the last few days is yesterday was a pullback, partly because of some margin calls, and it's very stretched at the moment. So there's a little bit of an opportunity to take profits, and it does look expensive, just that vertical rise. But I'm wondering, this geopolitical uncertainties, could ramble on for a while. But the implications of that, does it then become an inflation hedge over time? Does that value still? It's all right. So I don't think it's going to rally at the same pace that we've seen, but I don't see a massive sell-off either. And actually, I was looking at the last time we saw gold rise like this was back in the Iranian Revolution, I think was one example.
Late 70s, early 80s.
So the 70s, when you had inflation, geopolitics, everything. But then it just collapsed. So there's always that fear. What if it just, sells off and then a few months from now we're down $1,000 or something? But I think this time, there's a lot of uncertainty, but you have that combination of potentially structural inflation, which is something that we were sort of discussing in the room earlier. But there are these the cyclical drivers of inflation, but you also have globalization, technology, and demographics. These are all structural drivers of inflation. Demographics are moving in an inflationary direction. Deglobalization has just been fast-tracked because of the US administration. Again, a structural driver there. So it does look like that inflation hedge component could become, another driver. So I'm not saying that now is the time to enter and you go to 3,500 or 4,000. I think I wouldn't discount it completely. Take profits now, see how the land lies in a few weeks. But I think if this inflation story continues to bubble on, it might be a good hedge.
Coming through. And what about with using gold versus the investment in CBDCs and stablecoins? What should be what are your views on that? Given that we're seeing as well the change in the regulatory environment around both stablecoins and other tokens.
Well, the utility of stablecoins, CBDC, crypto, and gold is totally different, right? And when I say utility, I refer to actually real world use cases. CBDC is purely a payment instrument. It's currency. It's just digital currency. So the e-dirham has been formally announced, I think, a couple of days ago, last Friday or Thursday. It's a project that the central bank has been running for the last 3 years. There was a precedent with Sama, Saudi Arabia, on Project Aber. Then Project Harper was dropped. They started this other project with the central bank in the UAE. There are three different CBDC here. We have domestic CBDC. And the cross-border CBDC. Cross-border CBDC is divided into different projects. We have Bridge, so the combination of UAE, China, Taiwan, Hong Kong. That's really like a trade, intra-banking and trade instrument. Then there is unilateral CBDC that started with India as a project. India is the largest trade partner of the UAE, so that's why India. But now there are different agreements, unilateral agreements that they're closing. The central bank is closing with other central banks. So this is really purely trade, cross-border payments, wholesale. Domestic is more of a retail type of usage. It's very, very interesting. It's really like to digitize, financial include. When you look at CBDC, why you do e-dirham, why you do an e-currency, the euro and digital euro. It's financial inclusion, it's innovation, you allow for wallet, but eventually it's a mean of payment.
What about Bitcoin or other cryptocurrency tokens that we see, obviously through the ETFs? They've been very successful.
Other tokens have different utilities. So again, so means of payments purely, and I don't even compare CBDC with crypto or stable coins. CBDC is central bank money.
Yeah, absolutely. But thinking about gold versus other crypto products, such as the Bitcoin ETFs, the ETPs.
That's instead very, very much comparable. So you have kind of the same, but not the same, but very similar fundamentals, starting from a limited supply, starting from a way to preserve value, from hedge against uncertain market conditions. Again, utility might be different. Access might be different. Bitcoin, other crypto, and stablecoin are instrument assets that are way closer to the traditional financial markets, I think. So there is this convergence between TradeFi and DeFi that actually eventually increase adoption.
Okay, so we've discussed oil a bit and the impact obviously that has on this region, gold, some views on that. I'd like to get a little bit into some of the wider geopolitical issues because, again, everything about this is very much dependent upon what happens next in terms of Trump's willingness to negotiate. It's causing serious doubts on the future of the post-war international order in many ways. So we've discussed the immediate short-term risks. Where does the panel see the medium to longer-term risks coming through?
I can just give the framework, but I wouldn't get into details because it's very difficult to predict. But I think from a bigger picture, if you just step back and see what has been happening, we had, since the World War, we had Cold War between US and another power, which was the Soviet Union. And with the collapse of Soviet Union, we had a unipolar world from 1990 onwards. And that unipolar world where US was the only power, or if it had been any other power, it doesn't matter. A unipolar world gave us peace. And that allowed for globalization to flourish. In a bipolar world, we wouldn't have achieved the globalization that we achieved, and we wouldn't have had the prosperity that we had in the US or the prosperity that we saw in the rest of the world, especially in emerging markets coming out of poverty. That was all thanks to unipolar world. Now, with the emergence of China, and I explained the industrialization of China, we have this unipolar world getting challenged by another power, which also seeks global dominance, but global dominance more from a trade and business perspective. Nevertheless, it is challenging the other power. And now what we are seeing currently, the risk is that we are not just talking of a bipolar world, we are now talking of a multipolar world, where there are different power centers which are wielding their own influence regionally and globally. So if the unipolar world gave us all the benefits, the move away from unipolar world to multipolar world is likely to take away all those benefits and is not so desirable, and it's not good news. Actually, it's a very bad news from from a global geopolitical framework, and for anybody, whether it's a businessman or a consumer or a country. So that, for me, is the wider picture which worries me.
But isn't Trump trying to pull back into that unipolar world?
Trump wants a unipolar world. He's trying to create back a unipolar world, which will definitely benefit the US if he is able to succeed. It's very unlikely that he will succeed in this, given how much of it has already got dispersed. So it's very unlikely. He will challenge the multipolar world where it's very difficult, and we have various power centers. And the contradictory part about Trump's policies is that at the same time, he doesn't want to delve into regional geopolitics. He wants to pull his military and his spending away. In fact, he's saying, if I give you military cover or security cover, and that's the Mar-a-Lago Accord, if I give you security cover, then you need to pay for it. And you could pay for it by converting your US treasuries into 100-year non-interest-bearing bonds or whatever. So there is a bit of contradiction over there. I'm not very sure he'll be able to achieve it.
Any other views on where we see the major risks for the medium to short term? As I said, we know the uncertainty around tariffs. As you said, by the end of this meeting today, things could have all changed again. We never know what's going to come out of Trump's mouth. But in terms of those, particularly those medium-term risks, what are we thinking in terms of equity markets? This is because we are starting again corporate reporting season coming through soon. Starts next week, I believe. The major reporting coming through. We're seeing the potential hit to companies. We see the dollar flipping about. Again, these are short-term things. As we're looking more towards the medium term, potentially whether or not that agreement will get closer to unipolar or not. But for that medium term, so let's think about, if we can, more of about 6 months out, a year out.
A year. I think my concern, not a base case, but my concern is what happens to inflation, especially if inflation expectations are picking up. So I think my fear would be that if we get to the end of the year and tariffs have stuck, and we're starting to see this dynamic where you have what was feared during the pandemic was this wage price spiral. So that's more of a business cycle impact. If the Fed and what happens in the US is quite important here. If the Fed is stuck in terms of because of inflation, isn't able to support growth, then what happens to inflation expectations? I think ultimately what they'll do is they'll start easing, they'll start supporting growth, but we could be in a world where you start to get into that spiral potentially, and that's what happened. If we think about the 70s, that's what happened in the second half of the 70s. Because that spiral started to pick up. Mm-hmm. I think it's just a risk to consider over the course as we go into 2026 and beyond.
And of course, we're going to see greater policy divergence through central banks, implications for bond markets.
Yeah, I mean, the way I look at it is obviously inflation is a main concern, and inflation expectations mainly. Just one point with regards to the way I look at the two words, I think competition to a certain extent is healthy. And the example we gave earlier, just like having the option to buy BYD or Tesla, for example, DeepSeek or ChatGPT, Alibaba or Tencent versus ATM, the option to have creates a healthy competition. Obviously, this stops being healthy when you have a struggle for power, and this power turns into war, direct or indirect war. That's the. I don't know if it's a positive at this point. It has shown that so far, to a certain extent, it is. Inflation is obviously a main concern. Inflation expectations are a main concern. Recession versus stagflation are a main concern. If we end up being in a situation where growth slows down, but not enough for the Fed to be able to cut rates, or inflation does not drop enough for for the Fed to justify cutting rates. This would be. We've had 2 stagflations in the past that were horrible for the markets, and I think this is the main risk for the markets at this point. In our part of the world, the risk is, as I said, oil, which would lead to a higher funding needs. I mean, you've seen Saudi, it trades massively wider, like 40 to 50 basis points wider than similarly rated peers because of the funding needs. We've had record of 110 billion issuance last year. We think this is going to be a repeat this year. And the third factor is an increase in geopolitics, which would also fall into the risk premia in the region.
So those are very, very important points to consider as we are looking at a market that is, at this stage, predicting a higher number of cuts from a Fed that is saying we're stepping back a bit. So before we get to the question round, I would like to ask each of you the one thing you would like everyone to walk away with and sum it up in 1 minute. The main point that you're focused on, that is the immediacy on your horizon for whether it be the short term or the medium term or even the long term, but we're all dead in the long run. That one point. So whoever would like to start first?
Okay, for me, I think the one point would be to really consider diversifying across regions. I think that was when I was looking into what's happening in the markets at the moment, what is the outlook for the next 6 to 12 months. We have this administration for a term, there'll be some midterms that we can see how that influences the policy. But I think over the next year, it's still going to be a case of a very noisy and unpredictable policy backdrop. And that means, there's going to be periodically, there'll be concerns about the independence of the Fed or, what other country geopolitical risks sort of come out all of a sudden. So I think sort of trying to really diversify across, not thinking, so I talked about Euro earlier, not just looking at European companies, but really sort of looking a bit more broadly across the DMs and EM space, looking at sort of longer term themes as well. And this tech theme is still, yes, we're seeing a pullback, a huge pullback in Mag 7, but really looking at those tech space across different countries as well, and trying to really pick out those opportunities that can run for a longer term, even if there is some pullbacks, they've still got a structural story. So structural stories that I like are actually Japan and India, looking at opportunities there because there are domestic drivers that can really sort of add value over the next 1 to 2 years.
Very good points. Serena, your big thing you want people to walk away with?
Tokenization of real-world assets, hands down. Democratized access makes everything, literally everything we know, accessible and programmable. In real-world assets, I include stable coins, so currencies. So it's stable coins, it's real estate, it's energy, it's commodities, so oil, it is intellectual properties. So everything we are saying about, diversify across markets, diversify across assets, this is actually made possible through tokenization and RWA tokenization. So incredible tool. And then it's something that all regulators around the globe are fully into, including Saudi Arabia, that is not really like a crypto pro market as of now, but they're very keen into the organization, and for this region is massive. Having Saudi Arabia in then gives access, and emerging markets. So I think that's the team.
From my perspective is, as I said earlier, don't try to be a hero. When uncertainty is high, it's actually high, so might as well, unless you're really sure of what you're buying, don't buy it, go on the safe. Don't buy it because everybody else is buying, because everybody else might be wrong. And diversification is key now, and we've seen diversification across asset hasn't really paid off recently, so I think that private credit is a main theme that is growing in our region, and I think that it offers a real diversification because it's not a benchmark plus, given how much high yield it is. It is high yield, but at the same time, the deal is so structured, and you're most of the times you're the only term sheet in the region. So it gives you a real diversification away without significantly increasing the risk.
Okay. Deepak?
I think from my perspective, especially for this region, is that investors in this region are underexposed to equities in general, or they are exposed to domestic equities only and don't have diversified equity exposures. I think that is the biggest risk that investors are carrying. From my perspective, global diversified equity exposure is very important, and that we should continue to invest regularly, irrespective of the market conditions, because over the long term, equities have outperformed every other asset class. But the other risk that investors take while investing in equities is they start looking for that winner stock that they want to own, but that's like looking for a needle in the haystack. And so we go back to the old wisdom that don't look for the needle in the haystack, buy the haystack instead, which is buy the index. So we genuinely believe that global equity indices, diversified equity indices, is something that investors can very easily access through ETFs, extremely low cost way of accessing that, and that they should continuously build their portfolios. When you get drawdowns like these are the best times to invest large amounts, because from a 2-year, 3-year time horizon, you're always going to make money. Finally, equities are not for trading, equities are for investments. And I think that's the other mindset that we need to get comfortable with.
Interesting point of view. What I'm going to do is open the floor to some questions now. I'm sure there are questions from the audience. This has been a really, I think, fascinating discussion. We've covered everything from oil, gold, stable coins, cryptocurrencies, ETFs, bond markets, and of course, geopolitics. And we know we're in an incredibly volatile time, so I'm sure there's some questions out there. Just raise your hand and the person with the microphone will come round. Well, we'll go right to the front, obviously, with Gaddis. You start us off.
Hello. I have a question to Mr. Deepak Mehra. You mentioned that balance sheets are strong in the US. You mentioned this was related to bank balance sheets, right? Or in general, to which balance sheets?
Oh, okay. No, what I meant was balance sheets in the corporate sector in general.
So less leverage and
yes.
strong. Okay. What do you think about bank balance sheets in US?
Well, the bank balance sheets of the large banks are fine because they are so heavily regulated with capital requirements. Now, when it comes to regional banks, the balance sheets are by and large regulated by the same norms, except you may have situations where the bond portfolios may have mark-to-market losses, but then that's held to maturity portfolio and shouldn't matter. So it's only the Silicon Valley Bank was a aberration, and I don't think that's something that overall the banking sector in the US has to worry about. I think it's fairly robust. Not only that, the consumer balance sheets are also very strong. So if you look at the consumers, their debt servicing as a percentage of their disposable income is at historic lows. So the consumers are doing very well. The companies are doing extremely well. If you saw the Q4 results, they were robust. The profit margins are at record highs. So imagine, even if this tariff comes and companies have to absorb part of the tariffs, they have that room to absorb. So it's not going to be the end of the world. And that is the comforting part that I'm looking at in terms of the balance sheets.
We've seen a shift from corporate leverage to sovereign leverage in 2008 at the crisis, and we've been through that trend since then. And the recent increase in the hike in interest rates caused the massive deleveraging also, because it simply became very expensive to lever up. So, and when you have volatility, this also causes people to stand back, especially say hedge funds that usually go heavy leverage, which causes also another volatility in the market. So when you are in a trend like Back in 2004 or 5, you had a straight trend. So you could lever up, you could see where you're going, you could invest. When you have this sort of volatility, you usually tend to hold back to see what's happening, especially from a leverage perspective. And a lot of people went into the market, be it fixed income or equity or equities. I mean, fixed income absolute yields are at record highs. So you'd rather be invested because your opportunity cost is different and your cost of fund becomes significantly high when you're levered. So that's why also you have less leverage.
Okay. Another question? Oops. In the back, please.
So very insightful discussion. My question to the panel is two sides. One on the equity side. I understand that you want the investors to step away from US, diversify. That's the key word. In terms of diversification across countries and across sectors, where do you see Euro defense as as one sector where you would want to diversify away from the Mag 7? And on the fixed income side, what is the duration that you're targeting? Are you targeting like a barbell strategy, or you are doing something where you are diversifying across countries, or as on the spread that you just pointed out in your discussion before? So two questions on the equity and the debt side.
Okay.
Go ahead, you want to take the
Equities, I can begin, and then maybe you can add, Sree, and then fixed income, Zeina will respond. I think I didn't mean that you diversify outside the US. I meant have a global diversified portfolio. According to me, US remains, from a MSCI world perspective, still the biggest market in the world, so we can't stay away from the US. US exceptionalism for me is not dead. It's very much alive. And for me, the European, or what we are seeing in Germany is not rest of the Europe. Germany only had 60% debt to GDP ratio, and therefore they could announce these massive fiscal expansions. Can you imagine France announcing this? The day they announce something like this, either France or Spain or Italy, their borrowing costs will go through the roof because their debt to GDP ratios are already 100% and above. So Germany is a unique case, and that is not going to benefit all of Europe. It will only have a trickle-down effect to the rest of the European countries, but the rest of Europe has no chance of following Germany. In fact, they are suggesting that euro-wide bonds should be issued to fund for defense expenditure and so on. That nothing will happen. Germany is just what will benefit. So we need diversified portfolios, but we can't move out of US, and Europe is not the only place, and that's not very encouraging. Maybe Germany is the only place you could invest in. Germans don't invest in their own stock market, by the way. It's all mostly foreign owned. So, but yeah, there could be opportunities in emerging markets. China looks very cheap. Domestic plays like Sree mentioned earlier, like India, Indonesia, Japan. Japan has been off the radar for so long, and now you have healthy inflation coming in Japan, which means businesses will do well, there'll be growth and so on. So yeah, there are pockets. But if I'm a lay investor, I can't go looking again for needles. I would rather buy the haystack, which means I buy MSCI World, I buy US, I buy emerging market equities, but always stay in the quality sector rather than segment, rather than go into looking for the next big things. That's on equities, please.
I agree with the looking for quality. Especially in this environment, quality would be quite important. And also Germany is, I think the German defense stocks, we saw quite a big rally just after the announcement. I think across Europe there was a big surge then. And I think there's potential for that to continue, but we also need to remember that who are they going to buy? Are they going to make these defense equipment? Are they still going to have to buy from the US? So I think looking specifically at defense, it might be a little bit more nuanced than just looking at that particular sector within Europe. I think also, as I mentioned, as we discussed, like Japan, for example, there's the inflation side, but I think there's the corporate reform story, and I think that's actually very powerful longer term for the Japan structural driver. Because they had a lot, and that was really dragging the Japanese equity market down. It wasn't just a deflation story. They're still in that deflation mindset, however, the Japanese consumers, but I still think that this corporate reform is going to be it's still ongoing. Quite a lot has been done. This sort of cross shareholdings, that's all being unwound, and we're still early on in that stage. So I think there are lots of opportunities there to look at. So I think taking this sort of long-term stories, defense is a long-term story, but I think in terms of who's producing what and who's going to buy from where, I think that might be something to consider.
And on fixed income, Zeina?
Yeah, from a fixed income perspective, they've never been, fixed income for the past 10 years hasn't been as attractive as it is now. So you have benchmark rate at all-time highs. Spreads are relatively tight. We've seen some bit widening yesterday, but relatively we're still tight. But your absolute yields are a no-brainer. With regards to where you be, I'd rather be in investment grade right now because it gives you, in case of given the volatility that we're facing, I'd rather be in the investment grade space or in the good quality high yield. High yield does not necessarily mean junk. You have very good quality high yield to be in. With regards to the duration, right now, given the volatility, I'd rather be neutral duration to slightly underweight for things to pan out and see what happens, especially that you're paid to wait, right? So if you buy a 5-year paper, you're pretty much paid to wait, and you're having an all-time high absolute yield. So I think the recent move also, if you look at the move in Tadawul, for example, on Sunday, that was minus 7%, versus the move in regional bond market that happened on Monday, which was IG was anywhere between 15 to 30 basis points, and it came back. This shows you the massive benefit of being into fixed income and diversifying your portfolio into both.
Absolutely. Are there any more questions?
Here.
Right. Jump with the microphone there, then we'll go over right there.
Thank
Please.
you for the great discussion. My question is regarding global population is aging and how it will affect economy in 5-10 years, given that US, China, and Europe population is aging. That's a question to all panelists.
So that structural shift that Sree had mentioned earlier, looking at demographic change, the impact that you see this happening on markets moving forward, both equity and the types of stocks that may or may not benefit from that, or sectors, I should say, within that, as well as, again, if we're looking at fixed income, or if we're looking at it in terms of people just saying, you know what, I'm going to invest everything in crypto because I believe it's a younger, even though it's an aging population, we have a bit of a balance on that as well, of the younger population, particularly in emerging markets, who are much more invested into crypto. So what are your views on the demographic impact?
Okay, I'll just give my views and then maybe you can add to it. I think the world is aging, but at a very good time, we have technology like AI and general AI, which is coming up. So the only problem with the aging world are two. One, consumption goes down, and number two, productivity goes down. The productivity factor of the aging population will be substituted by technology. So where productivity was provided by humans, now productivity can be provided by technology. So we don't need fancy technology for this. We are not saying humanoids are required, but it's just that when machinery becomes smarter and when you start using intelligence in that machinery, it can start substituting humans. So the productivity side can be easy to manage. It's the consumption side which will be a challenge. So if you now look beyond the next 20, 30, 40, 50 years, it is very likely that we will have deflationary conditions. We would have much lower employment opportunities. We will have much smaller population, shrinking working age population. And therefore, the world would be far more stable and would be heading back towards what we saw before the Industrial Revolution, where you may need fewer things, things will be much cheaper, and there'll be less demand on humans to perform. So all in all, if I look beyond 50 years, I'm heading towards a utopian world. Now, if you extend the argument of AI, there are two authors that you should read. One is Ray Kurzweil. Ray Kurzweil has multiple PhDs. He was one of the founding engineers of Google. And he talks about the singularity is near. That is his book. And he talks about this utopian world. Whereas on the other end of the spectrum, Yuval Noah Harari has written a book called 21 Lessons for 21st Century. He's an Israeli professor, and he is also a futurist, and he gives you a very dystopian future where, because of technology, AI, and so on, hundreds of millions of people around the world will not have jobs. By the way, which looks very, very much possible. We can already see how many jobs have disappeared around us in the last 10, 15 years. And more dramatically, they'll disappear. So you can have these dystopian and utopian outcomes of technology, and maybe they will coexist, and it will depend upon where we are and who we are, that we would be facing dystopian future or a utopian future. It will all depend upon how we position ourselves. I don't know whether this was too much of an answer for your simple question, but maybe I've confused you more. But if you want where to invest money, maybe then, yeah.
So I think I agree that with aging, I think technology is going to play a big role in this trend as well. It already is. We're already seeing, we have done even before the pandemic actually, in some Asian countries in particular, that this trend moved towards automation. Japan, again, I come back to Japan, they have a labor shortage. They don't have very much migration. So they're really dependent on automation. So I think there'll be some pockets in terms of utopia, dystopia, I don't know, but in terms of like pockets of opportunities again, and there's also an inflation sort of story here. As I mentioned earlier, there are three main structural drivers of long-term inflation trends, and that's demographics is one, technology is one. Technology tends to be disinflationary. So before the GFC, we had this 20-year period where all three of these drivers, globalization, technology, and demographics, were all moving in this disinflationary wave that was really just carrying central banks along with them. We had the Great Moderation, and it was a good life back then. But now I think we have this sort of distorted set of structural trends where deglobalization is now, this inflationary path. And then you have tech, but who is driving this tech? I know that US, you have the Mag 7s, but you also have a president that is bringing manufacturing back and almost reining back in terms of technology is what it sounds like. It's like bringing jobs back, but other countries are looking at manufacturing as an automation process. So I think it's really important that people aren't fooled into believing there are suddenly going to be factory jobs available for them in plenty. It's very difficult in this aging environment to move in that direction. It would not be good for the US economy to do so. So I think really looking at who's driving this, and across Asia, it's so high tech, those communities, those societies, across China, smart cities, we don't have that in the West. Our infrastructure in the UK is like over 100 years old. Our tube system is creaking. These things are a big hindrance to productivity. My daily commute is hell, but also decreasing my productivity. So I think these looking at these nuances are quite important.
Definitely. Again, goes to the point of younger. We are seeing that change, particularly with emerging markets, having a much younger demographic.
Yes.
Very much having influence, which again we'll mention. I brought up crypto, but I know it affects, in terms of interest in crypto, it affects the types of industrial development that will be taking place as well, and that use of automation. There was another question right over there. Gentleman right behind over here, if you could please.
Hi there, my name's Andre. I want to be a little bit more controversial. Since I'm the last one, I might as well be. All your views are extremely conservative, very traditional, and medium to long term from your perspective. Now consider that many of us are EXANTE customers. We're active traders, as in we're in the markets day in, day out. We check our phones multiple times a day to see how our stocks are doing. And we're not necessarily investing in the traditional ways. when the stock market is crashing 20% down over the past couple of weeks, some of us are actually in the market, shorting the hell out of the market. And whereas the 99% or 90% of customers are down 20%, some of us are actually up 20%.
Congratulations.
Because we are, after all, in the age of AI. And Deepak, thank you very much for bringing that up. So the old ways of investing are not valid anymore. If you're losing money in this market, volatility, I would make the argument you're not investing correctly in the right asset classes or with the right asset managers or with the right technologies, going back to AI. Algorithmic trading, for example, AI-based hedge funds are making a shitload of money. Apologize my French. Making a boatload of money right now. Volatility is fantastic. Our fund, we're up almost 20%. We made half of that last week during the volatility. We want more of it, not less. And if the market crashes, so be it. We love it. We'll short the market. Leverage, fantastic. Exact opposite. We want more leverage. Give us more because we can make more money. And then by the time the market bottoms out, as Deepak mentioned, that's when we go cherry pick. We'll go pick up all the stuff that was overvalued just a few months ago. I mean, we hit all-time highs in all the markets. NASDAQ, S&P 500, the FTSE, you name it. All the tech stocks, NVIDIA, everyone's saying, oh, well, price to sales, PE ratios at record highs, it's overvalued. But now we're getting it at a 30, 40% discount. It's fantastic. So if you're a macro, long-only, long-term investor from a medium, long-term standpoint, this is kind of the best time to be in the market. I mean, Warren Buffett, has a lot of cash on the sidelines. Mm-hmm. So anyway, I apologize for the long monologue, but I just wanted to be a bit more controversial. Would love to hear your views on kind of the non-traditional ways of investing these days. Of course, we are in the age of AI. Thank you.
Sure. I mean, just to touch on there are hedge funds that are long short that are making money in this, but depends on what you are, right? When your clients are banks, institutional, big pension funds, institutional clients, going that high risk and long short, because you made money last week, but if the market if we go into a deep recession and we go into a correction or into which is not my base case, but deep correction and market down, when you're highly levered and you have at the same time rate going up, good for you if you're shorting at the right time and removing the leverage at the right time. So it depends also what's your strategy, who your clients are. Most of the clients can't do that specifically in the region. You surely have long short hedge funds, but the big clients, the massive institutional clients that are pension fund, retail fund, insurance companies, banks, can't have that high of a risk. So that's why you remain in that, what market trends are we going? And the strategy you're talking about is super short-term, very tactical. This can change tomorrow. So from a portfolio manager's perspective, if I come to my client with a 10% return and a 3 standard deviation volatility, I promise you they won't be happy because you need some sort of consistency for these big pension funds. Mm-hmm. So it's just simply a different investment approach and different strategy for the fund. So for a retail investor or a hedge fund, definitely that's the way to go. For different clients, it's different. So,
congratulations on your returns. Yeah.
Very well done.
You had another question here.
Yeah. Can we have a microphone?
You go ahead, and I'll speak the question out if you speak now. Yeah.
Thank you very much. My name is Evgeny, Alpha Barra Capital. So basically, my question is maybe quite specific. It's concerning the crypto. So we see that the legal framework is evolving rapidly, and we see the MiCA is coming into force in Europe, and we all observe this rivalry between USDT and USDC, and we all understand that with the new rules, let's say, USDC put in a little bit in more favored position in comparison to USDT. So anyway, that's the part of the game, and that's the part of tokenization, and that's the part of the CBDC that is coming. That's the well-established trend. However, could you spot maybe certain peculiarities that for sure will come into force? I mean, in relation between the CBDC and well-established stable coins. So we have now, let's say, USDT and USDC, and maybe in a quarter or in a couple of quarters, we'll have, let's say, CBDC policy with official currency. So what would be the relations in your perception? Thank you very much.
Thank you. Totally different, right? Totally unrelated to parallel binars. CBDC, again, is central bank currency. It's just an whatever currency. So it's definitely a parallel binar compared to stable coins and crypto. I actually personally believe stable coin can easily, I mean, obviously not replace, but go in parallel and have the same utility as other currencies, more traditional currencies. But yeah, they're absolutely not related. The use cases are different. The use are different. If we look at retail use, stable coins in theory make more sense, right? Because they're cross-border, facilitate remittances, can build corridors, trade corridors, cross-border as well, are an amazing way to settle internally for large corporate and large banks. If we think of, I don't know, the immediate example that comes to my mind is the Emirates, the Qatar Airways, operating globally. And they operate also in very specific markets where others are not present. Bangladesh, Pakistan, India, all that area of the globe that is very Egypt, Kenya, Nigeria, incredible issues in terms of currency devaluation, in terms of source of commodities and oil as well, right, and gas. So for these large corporates, using stablecoin to settle internally and to actually resolve the procure-to-pay issue is amazing, because they are able to repatriate capital in a matter of a day or two, instead of having capital stuck in Bangladesh for 6 months and seeing half of it back. So this is just an example, but you see the difference of utility between stable coins and CBDC. That instead is purely wholesale and government-led, central bank-led, and crypto again is different. If we think of equity and crypto, I mean, you were saying equity is investing, is a means of investment. No, it's always for the long run. Crypto is kind of the same. If you want to merge the two, go for MicroStrategy. Michael Saylor is doubling down again last week. So you go for both equity and crypto at the same time. Did this respond to your question, more or less?
Great.
All right.
Okay, we actually have run over time, but which is wonderful because it shows that there's high level of interest. We're really grateful for that. First off, I would very much like to thank our wonderful panel. So we can give them a round of applause, please.
Thank you. Thank you.
And of course, I would like to not just thank the panel for sharing their thoughts. I would also like my colleagues who've helped to organize and promote today's event, some of whom are in the room, and of course, outside. So I'd like to big thank you to them. And of course, thank you to all of you for joining us today. I hope you got something out of this. It's an exciting time. It's a volatile time. It's an opportunity to make money. It's an opportunity to lose money. But we're very, very grateful that you came today. So before we go, I do have one last request, going back to the Slido. If you will have that on there, I don't know if the numbers are in. If you could please kind of go through these questions within the Slido, how useful you found this event. I'm going to move along to the other ones, just so that it helps us know, a bit of feedback for us, in terms of what we can do for you moving forward. In terms of the organization, I'm not going to go through all of this right now, and we want to get out there, and what you would like to see more of in terms of future events, and any additional comments that you may have. We'd very much appreciate that feedback. And with that, I think we shall be heading out. I'll let Adrian close this up, but we'll be heading out shortly.
Hi. Hello. Hi. Thanks again, panel. Thanks for a great discussion. We're going to wrap up now. Thanks, everyone, for coming. We are going to have a cocktail reception and some nibbles on the viewing deck that's going through the hotel. So if you want to make your way slowly outside, there's an entrance you can go through. You'll be directed by the hotel staff. There's an elevator that will take you up to the 4th floor and then out to the viewing gallery with the Burj Khalifa. Should be lighting up anytime soon, and there's obviously the fountain show, etc., etc. So please join us there. Most importantly, you can pick up a gift that we've prepared for you as well on the viewing deck. So thank you again. Thanks to our panelists. And we look forward to catching you. If you see the badges, they've got different colours. So the team badge at the bottom, you can see who the people who work with EXANTE are. Feel free to come up, talk to us, myself, Gattis, Ashraf, any of the team if you have any questions. And obviously the panel hopefully will make themselves available for conversations as well. Thank you.